audit planning is very key to any successful audit. So we cannot skip any audit exams without looking at the planning analytics. You always find this, whether in intermediate or advanced audit. So we want to look at audit planning, materiality, and risk of misstatement. All right. So we jump into it. And once again, I'll say that this is not comprehensive enough. Using the core text will help you to better understand what to do when you are planning your audit. So what are the audit objectives? Why should we meet? Why should we set up the audit objectives? Okay. And then we'll look at meanings attributed to specific phrases in the audit context. Professional skepticism, we may slightly touch on it. Simply says that question everything that comes to mind in a professional manner. Okay. So don't accept any explanations as it is. Don't accept any document as it is. You must always have a question in mind. You are not bloodhounds, you are watchdogs, but still question. Okay. Then the components of audit risk, there are three. We'll look at that quickly. Now, what is meant by materiality and performance materiality factors affecting audit planning, the client risk evaluation process, how do we understand that? And then we'll look at the client system. You must understand the client system so that you use it in planning. Then there are three main stages of audit: planning, during, and after, right? And then we look at the audit planning process, and analytical reviews will be looked at. In fact, we'll look at analytical reviews in depth during the audit evidence section. And then look at the timing of audit visits. All right. So ISA 300 asks us to plan the audit. Okay, so establish an overall strategy. So when they ask you, what is the audit approach? What is the audit strategy? We're simply talking about what is the planning approach you are using. So you set the scope, the time, the direction of the audit, and then something to guide you, plan the audit and develop the audit program, and then to execute the audit plan perfectly, all right? Why do we plan audit? A number of reasons, just a few of them here. It helps us so planning entails an overall strategy. It also involves a detailed approach to look at the nature of the work to be done, timing of the audit, and extent of the audit. And then planning also entails developing procedures, which will help you gather sufficient, appropriate evidence in respect of specific disclosure. So it will help you design some audit procedures, which can help you, may likely lead to detection of fraud. And it will also help you to validate the directors or the management assumption about their company surviving at least for the next 12 months. That's what they are saying. So planning is a continuous process. It doesn't end. You can keep amending it. So reasons for planning, it helps you to devote appropriate attention to important areas of the audit, helps you to identify and solve problems on a timely basis, to organize the work in an effective and efficient manner. It helps you to select staff for the audit and facilitate direction in terms of the provision of the audit work. And if there are audits, if they are experts, it helps you to coordinate these experts and other auditors. So these are some reasons for planning an audit. What is the planning process? Understand the client's business. Then you plan an outline of the audit. Look at previous year's files. You can't go without this. Have there been any changes in the accounting policies which the company is using, or any legislations, laws, regulations governing the audit? Has there been any changes? Now, review management or interim financial statements. So management will have some statements, they will have some interim. Midway into the year, they will have some financial statement, and then sit with senior managers and then let them understand this is what we're coming to do, this is what you expect us to do, this is what shareholders want us to do, these are the timing of our audits, and this is what we will deliver, okay? So the planning process deals with timing, the kind of work to be done by the client staff and what is expected to be done by us, the level or the number of staff we are bringing to the audit. So you would expect that this guy is a senior auditor, this is an intern, or this is a trainee. So we let them know. If there are any problems, we will discuss it amongst ourselves as the audit team before we move to the field. There's always the need to prepare a budget, because sometimes auditors will travel. There are audit expenses normally borne by the client. Audit fees, the charge we are charging you for the number of hours we are investing in this work. Now, liaise with the client on key dates. Maybe you want to visit your site in in the northern part of the region, and you agree on dates. Okay. Then we have what we call the audit planning memo. I'll give you an example of this at the end of this planning slides or presentation. So planning should be detailed, very detailed. So look at the terms of engagement we sign with the clients. What are the reporting deadlines they expect from us? Now, the industry in which the company exists, consider that and review what is happening in that industry. If it's a banking, look at it. Are there any banking crises? Like I said, look at previous year's file, and then it will help you know what to do next. So if you forget to plan, look at the previous years. If you forget history, you suffer in future, right? Now, assess the effects of changes on the business, on their business strategies, on their financial performance, on their reporting requirements, on their operating style, and on the management. Now, the audit planning process, once again, like I said, look at any legislations, any accounting practices, any rules and laws. Have they changed? How does it affect the company? Now, the auditors should have a very good understanding of the accounting and internal control system of the company. And of course, of any general accounting control systems and any changes in accounting procedures. You should be, that's why professional competence and due care is required of any auditor. Be abreast with current knowledge. Now, who are we going to involve in the audit? Are we going to also include internal auditors and any specialists we need that? Then you consider what we call the planning, the materiality levels, okay? So there are 3 dimensions which I would like you to visit or to review. So we look at the revenue to set materiality, the profit before tax to set the materiality, yes. And then we also look at the assets, total assets. So look at the percentage thresholds. Now, in determining the audit approach or in planning, a number of things come into play. So you will test controls, you undertake substantive testing, you will use analytical reviews, you visit the site. All of this will help you in drafting a comprehensive audit plan and audit program. So the planning procedures, like I said, number of things I've mentioned here: prepare an audit planning memo, look at who is going to the field, the experience, you need any specialist skills, timing of the audit visits, prepare budgets and the fee estimates and give it to the client. That will normally feed into the terms of agreement, okay? Now the audit planning memo, like I said, what does it include? It talks about everything about the audit. Let me put it that way. So a brief background of the business you are going to audit, the environment in which they operate, the management, their background, okay? The outline audit scope for all major profit and loss and balance sheet account headings. What are we going to do? How are we going to do it? Why are we doing it? When are we doing it? We look at everything. So the outline scope, audit scope. Then the timing and reporting requirements. What are we going to audit? When are we going to provide these reports? Which reports are required? Then the timing of critical phases of the audit. I'll show you a diagram in this particular video. Again, proposed liaison with the internal audit. Are we going to work with the internal audit? So ISA 6210 talks of the external auditor placing reliance on the work of the internal audit. Why? Under which circumstances? We need all of these. There are a number of techniques we use. Typically, we have the flow chart and the ICQ, internal control questionnaire. So like the name flow chart talks about, it's a pictorial representation of the company's system. We use standardized symbols. So it shows us, it documents the flow of transactions from initiation to completion. It is easy to understand, relatively straightforward to update. Disadvantage is that it can be complex sometimes, and we always need supporting narratives to support the flowchart so that anyone can, without a good understanding of what it can understand how the flowchart works. Then we have internal control questionnaires. They are actually simple questions which will help the auditors understand the system that the business is running. Okay. So they are used to record the client system. They're asking questions like, who prepares the bank reconciliation? How often is the bank reconciliation prepared? What are the inventory control tracking systems you have? Okay, something like that. So they are quite simple, straightforward, and they require descriptive answers. I'll give you an example at the end of this as well. So they augment the flowchart narratives. And if you combine the two of them, oh, wow, you get a very great system of audit planning, okay? So it also will help us to understand first areas where there are weaknesses. Now we have what we call the walkthrough test. So you pick the invoice and then you trace it from initiation to the financial statement, initiation to end, okay? So when you undertake a walkthrough test, it helps you to better understand the system. So you know there's an order placed by a customer, it was processed, products were dispatched from warehouse, then delivered, then payment was made, the ledger was updated, it then ended up in the financial statement flow through. So when you take this walkthrough test and you do it, it makes you understand the system better. Ideally, for every area of audit, you might want to take 1 or 2 walkthrough tests, right? So it helps you to better understand that controls are operating, controls work, okay? Then we have 2 types of audit files. The current file, what we use currently. So walkthrough test and any work related to the current audit are kept on the current file. The permanent file is something we always keep. It has been there, so we only update it. So you get the flowcharts, the ICQs, okay, the standard, maybe there are letters of incorporation, some management, which have been there and if not changed, the management, organogram, all those things, you get them on the permanent file, okay. These are the critical timing phases. So the start of the year, we have an interim audit, end of the year, then we go to the final audit, then directors will sign the accounts, auditors will then sign the accounts, then it is published and then presented at the annual general meeting, okay? So these are the specific timing. You can look at the supporting schedules available when directors are signing the accounts and of course the final accounts would have been available, all adjustments posted. There are problems associated with audit planning. You may have clients having the same year ends. It's difficult to always audit these at the same time, especially if you don't have sufficient staff. There could also be unforeseen problems. Sometimes it could be natural disasters, COVID struck, and how could you go to the office to audit? You audit human beings. They must be there to explain. But for COVID's sake, whom are you going to audit? So there could also be issues of fraud, poor internal control environment. Clients will also fail to provide information when needed. They can even produce it late. It will affect your planning process, right? The audit staff could be sick. They could be on holidays. They could be on steady leave. Even the client staff could be sick. They could be on holidays. There's nothing you can do, right? Now, we also need different grades of staff and adequate supervision on each audit. Sometimes you don't get the required grade of staff. You need specialists. You need specialists who will help you. And there could be tight reporting deadlines. Sometimes auditors will have to sleep at the workplace. Some suggested solutions to these problems. You might need to organize interim audit so that the final audit will not be so heavy. So go in 9 months into the operations, do interim audit for 9 months. And then afterwards, you can do another audit at the year end. You should also have pre-planned important dates, cut-off dates, attendance at stock taking, debtor secularization, okay? If you know there is an audit coming up, you must pre-book holidays so that it doesn't clash with the audit timing. Cooperate with internal audit, they know the system. Liaison with the client on progress of schedules is very important. Work with them. There are some auditors who go, they sit behind their desks, they finish their work, and they present the report. And the client will say, we know not what you are saying. We don't have any understanding of what you are saying. To become a banter, a give and take. You must always allow extra time, an additional time for any unforeseen circumstances, okay? If you want to plan audits efficiently, there are a number of things we also want to put in place. Establish efficient time recording and costing methods within the audit firm. Prepare detailed time and cost budgets. Ensure that you have the necessary skills and staff who will do this work, who is going to work on taxation, who will work on inventories, and also maintain good and consistent working practices. Don't change the approach too much unless it's necessary. There can be poor auditing when there's no planning. Sometimes we even begin the audit before we start planning, which is terrible. And also sometimes the audit was based on a plan that hasn't changed in years. So the same thing is being repeated year in, year out. Sometimes auditors also don't understand the client. ISA 315 requires that we understand the clients and the industry or the environment in which it operates, and then we will be able to assess risk of material misstatement. You must understand controls, internal controls. 3 items over here. There are some controls that address a significant risk, like processing controls and security controls over appropriate use of assets. There are controls over journal entries, adjusting entries, non-recurring transactions. There are controls for which the auditor plans to test operational effectiveness. So you must understand these controls that pose significant risk over journal entries and over operating effectiveness. Now, if you don't understand the controls, you struggle. So what are the controls addressing significant risks? The auditor's understanding of whether the entity has designed and implemented controls for significant risk arising from non-routine or judgmental matters may include whether and how management responds to the risk. Examples like review of assumptions underlying the statements, which are prepared by senior management, documented processes for making accounting estimates, approval by those charged with governance, and other controls that the auditor feels they are appropriate to deal with. And normally these ones are more with judgment and estimate, but they are very significant. Audit planning and risk. Now, there are 3 things we will want to look at here whilst we wrap up. So the planning process, as well as any logistical factors, should include an estimate of audit risk. What is the audit risk? Audit risk, the risk that we end up drawing wrong conclusions or providing wrong opinion. So the audit risk that will give an incorrect opinion, okay? And it's a function of 3 things: the risk of material misstatement and detection risk. The risk of material misstatement is the combination of control risk and inherent risk. We'll look at that briefly. Detection risk is the risk that the auditor's control processes will fail to detect material error or misstatement. And the risk of the assessment of risk can be a matter of judgment, right? Now, risk of material misstatement is assessed at the overall financial statement and then the individual classes of accounts. Okay. Now, if it's pervasive, we'll clearly end up asking them to adjust the accounts or modifying our report. Now, inherent risk. So I'll simply say the risk that there are no controls, or the risk that the controls are not working. Okay, there are no controls. I will normally go for no controls. Now, there is that a material misstatement will occur, a significant material misstatement will occur, or whether a particular transaction as a whole, without consideration of any internal controls. That's it. So examples like quality and experience of management, so they are derived from the quality and experience of management, level of competition in the market, complexity of operations, cash situation and trading history, and the nature of the business itself. And these are factors which affect inherent risk. I would want you to take a good look and read these. Complexity, subjectivity, change, uncertainty, and susceptibility. Okay, I would love you to take a good look and read these from the core text. There's a spectrum of inherent risk. And if I present this, you see that the higher the likelihood and the higher the magnitude, then the higher the rate of significant risk. But if the likelihood is lower and the magnitude is lower, then there's a lower risk overall. What are we saying? The likelihood that it will occur if it is high, the impact, if it is high, the risk is high. Okay, it's a simple risk mapping analysis. So still on inherent risk, it also includes business risks, okay, which covers the entire business organization, as well as any assertion or transaction level risks. Okay, control risk. So at the business level, this is what we are talking about at the bigger level, the macro level, the cash situation, unusual incidences, history of the company, business environment, nature of the business. At the transaction level, we're talking of how easy for us to defraud this business, how complex are underlying transactions, degree of judgment involved in agreeing values, and and so on. Okay, control risk. The risk that the controls we have in the system cannot detect operational inefficiencies. Okay, so gone undetected. So these are control risks. So a combination of control risk and inherent risk gives us the risk of material misstatement. And they could be affected by the internal control itself. Again, amount of IT involved, complexity of operations, competency of staff, level of supervision controls, integrity of the staff, and the business environment itself. Okay, so again, ISA 315 gives us more details, and I will ask you again to read. You must understand at least one or two ISAs to help you, okay? So material classes of transactions, account balances, and disclosures which have not been determined to be significant. Try and understand this, okay? All right. Okay. For ISA 315, I'm reading the italicized items. They cannot miss out any material items simply because they assess risk as low or unlikely. So the fact that you've assessed risk to be low doesn't mean you should miss out on something. Detection risks, our control systems, our detection techniques, our audit techniques is not able to detect errors or material misstatements, okay? The higher the levels of inherent and control risk, the more audit work so that we can reduce the detection risk. Materiality, I asked you to look at 3 items, the profit, the revenue, the total assets. If you omit something which is not supposed to be omitted, if you include something which is not supposed to be included, materiality comes in from our accounting definition. I'm using a layman's understanding. Okay, so we need to set materiality depending on the size and nature of the business. Okay, and then when we also call what we call the planning performance materiality. So materiality here is at the highest level, and then we have the performance materiality, which is a bit lower to help us test the specific transactions. Okay, all right. So it can be subjective. It depends on the auditor's skills and judgment. Consider the effect it will have on the business as a whole and the effect it will have on individual transactions. Okay. So by nature, Companies Act requires us to do this. Okay. And like I said, performance materiality a bit lower than the overall materiality. Okay. All right. We're ending. Analytical reviews. I'll skip this because we'll deal with it in depth when we're doing the audit evidence gathering. It was simply looking at relationships and establishing patterns and helps us to plan our work, okay? It is done at the planning stage, during the audit, and the final stage. So planning analytics during the audit, substantive, final analytics at the final stage. Okay. Take your time, read through the analytical reviews here, but you'll find it more in the audit evidence. When do we do it? Before, during, and after the audit? How do we do it? Comparing relationships, horizontal analysis, vertical analysis, establishing relationships, comparing with similar organizations, comparing with industry benchmarks. There are limitations. Sometimes information used is not reliable. The fact that there's consistency in the relationship doesn't mean everything is okay. Okay, so we cannot just rely on it. Material items should be tested, not only using the analytical review. So I'm ending here. And these are the appendices I was talking about. So you could look at inherent risk factors, and then it gives you more detailed information here. Okay. Internal control questionnaire. This is an example of an internal control questionnaire, and this is a flow chart, can be complex, right? And then the audit strategy, example of an audit strategy. Another internal control questionnaire. There are questions you may try your hands on. All right. Good luck, friends, and I'll see you when I see you. All right. Bye for now.